Recessions are periods of economic decline characterized by a significant contraction in economic activity. Here are 10 of the worst recessions in history, based on their severity and impact. Welcome back to another exciting video. Today's video is about the 10 worst recessions in history. Before we start the video, please like, subscribe, and press the bell icon. The Great Depression, 1929 to 1939. The Great Depression was a global economic crisis that originated in the United States with the stock market crash of 1929, also known as Black Tuesday. It led to a decade-long period of economic hardship. The collapse of the stock market caused widespread panic and resulted in a sharp decline in consumer spending, business failures, and massive unemployment. The unemployment rate in the United States reached about 25%, and poverty and homelessness were widespread. It wasn't until the onset of World War II and increased government spending that the global economy began to recover. The Long Depression, 1873 to 1879. The Long Depression was a global recession that began with the collapse of the Vienna Stock Exchange in 1873. The financial crisis quickly spread to the United States and Europe, leading to bank failures, high unemployment rates, and a prolonged economic downturn. This depression was marked by deflationary pressures, reduced investment, and a decline in industrial production. It wasn't until the late 1870s that the global economy started to recover. The Long Depression began with the collapse of the Vienna Stock Exchange in May 1873, triggering a financial panic that quickly spread to other countries, particularly in Europe and North America. The panic was caused by overinvestment in railway construction, speculative lending, and excessive expansion of credit. The financial crisis of 2008 to 2009. The 2008 financial crisis was triggered by the burst of the U.S. housing bubble, which resulted from excessive lending to subprime borrowers. The collapse of several major financial institutions, including Lehman Brothers, created a global banking crisis. It led to a severe contraction in credit markets, a sharp decline in housing prices, and a significant increase in foreclosures. The crisis spread internationally and caused a synchronized global recession, with many countries experiencing a decline in economic activity, rising unemployment, and government intervention to stabilize financial systems. The financial crisis of 2008, also known as the global financial crisis, was a severe economic downturn that originated in the United States and quickly spread to become a global crisis. The oil crisis recession, 1973 to 1975. The oil crisis recession was primarily caused by the oil embargo imposed by the OPEC countries, primarily Arab members of OPEC, on the United States and other countries supporting Israel during the Yom Kippur War. This embargo led to a significant increase in oil prices and created an energy crisis. The sharp rise in energy costs affected various sectors of the economy, leading to stagflation, characterized by high inflation and high unemployment. The recession was marked by reduced consumer spending, increased unemployment, and a decline in industrial production. The oil crisis recession, which occurred from 1973 to 1975, was primarily triggered by a series of events related to the global oil market. The Organization of Arab Petroleum Exporting Countries, OPEC, led by the Arab members of OPEC, proclaimed an oil embargo against several Western countries, including the United States, in response to their support for Israel during the Yom Kippur War. The Panic of 1837 to 1843. The Panic of 1837 originated in the United States due to a combination of factors, including the speculative lending practices of banks, the burst of a land speculation bubble, and a decline in international trade. The crisis resulted in a severe economic contraction, with bank failures, bankruptcies, and high unemployment rates. The United States experienced a 6-year depression marked by falling agricultural prices, a decline in manufacturing, and widespread economic hardship. The Asian financial crisis, 1997 to 1998. The Asian financial crisis started in Thailand with the devaluation of the Thai baht, which exposed weaknesses in the financial systems of several Asian countries. It quickly spread to other economies in the region, including South Korea, Indonesia, and Malaysia. The crisis was characterized by massive capital outflows, currency depreciations, and high levels of corporate and banking sector debt. It led to severe economic contractions, plummeting stock markets, and widespread bankruptcies. The International Monetary Fund, IMF, provided financial assistance to affected countries to stabilize their economies. The Soviet Union collapse, 1991 to 1992. The collapse of the Soviet Union resulted in a severe economic crisis in many former Soviet republics. The transition from a centrally planned economy to a market-based system was accompanied by hyperinflation, widespread unemployment, and economic instability. The breakup of the Soviet Union disrupted trade relations. The collapse of the Soviet Union in 1991 led to a severe economic crisis in many of the former Soviet republics. The Soviet Union had operated under a centrally planned economic system for several decades, with the government controlling most aspects of the economy. However, in the late 1980s, the Soviet Union underwent political and economic reforms, including glasnost, openness, and perestroika, restructuring, under the leadership of Mikhail Gorbachev. These reforms aimed to modernize the economy and increase efficiency, but they also exposed the underlying structural weaknesses of the Soviet economy. The recession of 1981 to 1982. The recession of 1981 to 1982 in the United States was primarily a result of tight monetary policy implemented by the Federal Reserve to combat high inflation. The central bank raised interest rates significantly to curb inflationary pressures, leading to a sharp economic downturn. The manufacturing sector was particularly hard hit, with production declining significantly. Unemployment rose to over 10% and bankruptcies surged. The recession eventually ended as the Federal Reserve eased its monetary policy, leading to a gradual recovery. The post-World War I recession, 1918 to 1921. The post-World War I recession was a result of the demobilization of troops and the transition from a wartime to a peacetime economy. The sudden reduction in military spending and the return of soldiers to the workforce caused significant disruptions. Many industries, such as arms manufacturing, experienced a sharp decline in demand. Unemployment rose, and there was a decline in industrial production. The recession lasted until the early 1920s, when the economy began to recover due to increased consumer spending and a resurgence in industrial production. The European sovereign debt crisis, 2010 to 2014. The European sovereign debt crisis originated from the financial difficulties faced by several European countries, including Greece, Spain, Portugal, and Ireland. These countries had accumulated high levels of debt, and concerns about their ability to repay their obligations led to a loss of investor confidence. The crisis resulted in soaring borrowing costs for these countries, necessitating bailouts and austerity measures. The affected countries experienced significant economic contractions, high unemployment rates, and social unrest. Thanks for watching the video. If you enjoyed it, please like, share, and subscribe to our channel for more exciting content.